The credit card trio, the three key pillars that shape credit cards: payments, interest, and fees. Today, we're exploring Part 1, helping you understand how credit card payments work. Every cardholder makes payments, but did you know that payments can be applied to your account based on the type of balance you owe? Or that making only the minimum payment can be a costly financial decision? Worse yet, missing a payment can trigger a cascade of consequences that could impact your credit long term. Understanding this topic will help you make credit cards work for you without falling into costly expenses. Stick with me till the end. This is advice you won't want to miss. In this channel, we'll break down everything you need to know about credit card success made easy, one lesson at a time. As a credit card holder, making a payment every month is essential to keeping your account in good standing, especially if you carry a balance. Credit card issuers require at least a minimum payment each billing cycle, which is your contractual obligation outlined in your credit card agreement. However, paying more than the minimum can help you manage your debt more effectively. In fact, rule number 2 from the 10 Golden Rules to Master Credit Cards video advises paying your statement balance in full every month. By doing so, you not only avoid accumulating debt, but also maintain your interest-free grace period for all new purchases you make. Pretty great, right? How payments are applied to your statement balance depends on how much you pay and the type of balance on your credit card. However, specific guidelines established by the Credit Card Accountability, Responsibility, and Disclosure Act of 2009, commonly known as the CARD Act, a U.S. federal law protecting consumers from unfair credit card practices, determine how payments are allocated. Let's take a closer look. If you pay only the minimum and have multiple balances, such as purchases, cash advances, or balance transfers, your payment will be applied to the balance with the lowest interest rate. You should know that card issuers apply different APRs to each balance, which is something to be mindful of if you carry a balance from month to month. Paying more than the minimum. If your payment covers the full statement balance, your debt for that billing cycle will be paid off. If not, the payment will first go toward the balance with the highest interest rate. Any remaining amount will then be applied to other balances in descending order of interest rates until the entire payment has been allocated. Let's illustrate how payments are allocated with the following hypothetical scenario, where you have multiple balances. Statement balance, $1,000. Balances, purchases, cash advance, and balance transfer. Minimum payment required, $25. Amount you decide to pay, $200. Your credit card statement shows the following. Purchases $500 with an APR of 18.99%. Cash advance $100 with an APR of 24.99%. Balance transfer $400 with an APR of 0%. When your payment is applied, it is allocated as follows. $100 goes toward cash advances, as it has the highest APR. The remaining balance is $0. $75 is applied to purchases, as it has the second highest APR. The remaining balance is $425. $25, the minimum payment amount, is allocated to balance transfers, as it has the lowest APR. The remaining balance is $375. This scenario highlights the intricacies of payment allocation when you have multiple balances and APRs. Additionally, various factors may affect how your payment is applied. For example, deferred interest. If you have a deferred interest balance, a promotional offer with 0% APR for a set period, card issuers must apply any amount paid above the minimum to this balance first, starting 2 billing cycles before the offer expires. This is intended to help you pay off the remaining balance and avoid retroactive interest charges on the original borrowed amount. Installment plans. If your payment exceeds the minimum, it may pay off an installment plan earlier than expected. This could be beneficial, but it may not always align with your financial goals. Now, let's have a closer look to minimum payments. Minimum payments are a contractual obligation outlined in your credit card agreement. Depending on the card issuer, they may be calculated using one of the following three methods. First, a percentage of your statement balance, including interest and fees, typically between 2% and 4%. Second, a lower percentage of your balance, usually 1%, plus any interest and fees accrued during the billing cycle. Third, a fixed amount, often $25 or $40, applied when your balance is below a certain threshold, ensuring some portion of principal is covered. While minimum payments may seem like an easy way to manage your expenses, paying only the minimum will cost you more in the long run. Here's why, using a hypothetical scenario. You make a $1,000 purchase with your credit card. You opt to make only the minimum payment each month without adding new purchases. Your card's APR is 18.99%. The card issuer calculates interest using the average daily balance method without compounding and applies billing cycles of 31, 30, and 28 days based on calendar months. Your minimum payment is a fixed $25 per billing cycle. The result? It would take approximately 5.4 years to pay off your balance. You would end up paying $1,594.94 in total. You would pay $594.94 in interest alone, meaning for every $1 borrowed, you would pay nearly 60 cents in interest. Now you see why making more than the minimum payment is important. The Card Act mandates that card issuers must include a minimum payment warning in your credit card statement, outlining the following details: how long it would take to pay off your balance if you only make minimum payments, and the estimated total cost of repaying your debt under these conditions. This warning is designed to help cardholders understand the long-term financial impact of making minimum payments and encourage smarter debt management. Payment application rules. When making payments on your credit card, several rules ensure fairness and transparency in how those payments are processed. These guidelines protect consumers and help them manage their financial obligations effectively. Payment crediting rules. The Consumer Financial Protection Bureau requires card issuers to credit payments as of the date they are received, unless a delay does not result in additional charges. This ensures that payments are applied in a timely manner. Payment cutoff times. Card issuers can set reasonable cutoff times, but by law, they cannot require payments to be made earlier than 5 p.m. on the due date. This prevents companies from setting unreasonable deadlines that could lead to late fees. Late fee regulations. Late fees must be reasonable and proportional to the violation. The Card Act limits these fees to prevent excessive penalties for minor payment delays. Credit counseling resources. To support consumers facing financial difficulties, credit card statements must include a toll-free number for credit counseling and debt management services. Often, the toll-free number is listed as the customer service phone number. By understanding these rules, cardholders can make informed decisions, avoid unnecessary fees, and take advantage of available financial support when needed. If you miss a payment for any reason, you may face the following consequences as outlined in Rule Number 3. Pay your credit card on time from the 10 Golden Rules to Master Credit Cards video. 1. A late fee will be added to your balance, typically ranging from $25 to $40 per occurrence. 2. You will lose the grace period, resulting in immediate interest charges on both your remaining balance and any new purchases you make. 3. You may be subject to a penalty APR on your remaining balance, which comes with a significantly higher interest rate. 4. If you have a promotional APR, missing a payment could cause the rate to revert to the standard APR, increasing your overall cost. 5. Your credit score may take a hit, affecting your ability to qualify for favorable loan terms in the near future. The financial consequences of missed credit card payments become more severe the longer a payment remains overdue. After 30 days of non-payment, the missed payment is reported to credit bureaus, lowering your credit score. You may also incur late fees and penalty interest rates. After 60 days of non-payment, your credit score drops further, and your credit card issuer may increase your interest rate significantly. You could also lose promotional APR offers. After 90 days of non-payment, the account may be sent to collections, making financial recovery much more difficult. The delinquency could stay on your credit report for up to 7 years. If you're struggling with payments, contacting your credit card issuer early can help you explore options to minimize damage. Here are 4 strategies to help you stay on top of your payments. 1. Keep track of your payment due dates. Mark your credit card payment due date on a calendar or in your phone's reminders application to stay organized and aware of upcoming payments. 2. Set up payment reminders. Most credit card issuers offer email or text reminders a few days before your payment is due. Enroll in this service and take advantage of these notifications to ensure you never miss a payment. 3. Pay ahead of time. If you tend to forget or procrastinate, make it a habit to pay your credit card as soon as you receive the statement, rather than waiting until the due date. You can combine this strategy with payment reminders for added security. 4. Set up automatic payments. Consider setting up automatic payments from your bank account to your credit card. This ensures your payment is covered each month, even if you forget. Most credit card issuers let you choose from the following payment options: minimum payment, interest saving balance, statement balance, or fixed amount. If you decide to set up automatic payments, don't forget to review your credit card statement every month. Lastly, if you have an excellent credit history with your credit card issuer, you may be able to request an exemption from the late payment fee if you incur it as a one-time event. Simply call customer service and ask if they can waive the fee due to your strong track record of responsible credit card management. Your request is likely to be approved. Understanding how credit card payments work is essential for managing your finances wisely. Whether it's making more than the minimum payment, avoiding unnecessary interest charges, or being mindful of payment allocation rules, every decision impacts your financial well-being. By staying informed and making strategic payment decisions, you can cut unnecessary costs. The more control you have over your payments, the less financial stress you'll have. If you found this information helpful, explore the videos below to continue your journey toward credit card mastery. Don't miss out. Remember to hit the like button and subscribe to our channel so you stay updated on the latest tips and insights. We'd love to hear your experiences with credit cards. Share your story in the comments below. Thank you for watching.